I'm here in Dallas for REITWorld 2011, NAREIT's annual convention for all things REIT. I'm joined by Jeff Horowitz, Global Head of Real Estate, Gaming, and Lodging with the Bank of America Merrill Lynch. So Jeff, REITs were praised for their ability to recapitalize their balance sheets following the Great Recession. Where do things stand now as it regards to the fear of the looming debt maturities?
In terms of maturities, to put this in perspective, there's about $200 billion a year of maturities through 2017 that we're going to see in commercial real estate. Given the state of the overall marketplace, the view of the CMBS players, the number of private capital players that are out there today in scale, there's no way that we can see anything but a big opportunity for our sector. And we look at the acquisitions that they've done to date, we're going to find they've been very active. So in a year like this, we've seen almost 20% of the commercial real estate volume has been done by REITs. And if we look in some of the major markets, we'll see those numbers go up. And I think that trend is going to continue. When you look back at years like 05, 06, 07, when we thought that the REITs were quite active, those percentages were more like 6, 7, or 8%. So there's been a lot of activity already, and the most important part that I'll drive home is the REITs' balance sheets. So in 2009, the REIT sector was down to about $115 billion in equity market cap. That number is more like $400 billion today. So debt to market cap has changed dramatically. Debt to EBITDA, fixed charge coverage ratio, any metric we want to look at is materially better today than it was before. And REITs' access to capital, which is very important here, has been dramatic. So we've raised about $120 billion in capital over the last 3 years, about a little more than half of which has been equity. And today REITs have about $15 billion of cash on their balance sheet and about $50 billion of access to untapped lines of credit. So lots of numbers, but I think the point is there that REITs are prepared for an opportunity that pretty much has to exist over the next coming years.
And earlier this year, we saw a couple of very notable public-to-public REIT mergers. Right. Do you foresee more of those happening, and what would be the type of catalyst that would make that more likely?
And so if we think back about 2006 or 7, there's about $100 billion a year of M&A activity. And most of those were done because people took a view that pricing was either cyclical or secular. If it was secular, they were buyers. If it was cyclical, they were sellers. This year we've seen about $50 billion, which is more than people think. And the reason it's for the case that it's more than people think is because the deal's been very concentrated. There's been some very large deals. And so as we fast forward over the coming 12 months, I think we'll see 3 types of activity. We're going to see some public to public, and those will occur because there's been differentials in multiples. People have different views on where things should trade in the future, etc. Management teams may rotate over time. We'll see some activity in public to private because there's been some private players that have suddenly been able to access significant pools of capital, and we've seen the REIT sell good-sized portfolios to some of those players. And lastly, we'll see some private to public, which is a trend I think we'll see a lot of, where folks with single assets or portfolios will look to the REIT market to be buyers. And people will sell to them for diversification, up-REIT units, those types of things, and importantly because REITs have that access to capital in a market that's a little bit narrower in focus today.
Now here at REITWorld we're celebrating the 20th anniversary of the modern REIT era, and it was Kimco's IPO, which is kind of considered the starting point. The IPO market in 2011 hasn't exactly been as well received. What is your outlook for the IPO pipeline? Well,
again, when you look at this in context, the last 3 years haven't been that bad. We've seen 13 REIT IPOs. We've seen $6 billion of equity market capital being raised for the sector, which isn't terrible at all in the context of a 20-year period of time. I think when you look at the pipeline, though, the pipeline's not that big, but it's characterized by deals of some scale. It's characterized by different types of deals, so we'll see some. Whenever you have market volatility, it's hard to get certain types of transactions done, and when you add into it an election year and all the environmental aspects that are going on today, it's hard to see a situation where we see great activity in the next very short period of time. But as we look forward, there's many high-quality companies that are out there. There's many high-quality companies that went private, where debts are going to mature over the next few years. And so long-term, I'm bullish about the growth of the sector from that perspective.
Great. Jeff, thank you very much for joining us.
Matt, thank you so much.
For more from REITWorld 2011, be sure to visit REIT.com.